Hello, and welcome to the market update for Tuesday, April the 5th. As always, if you have any questions during the week or any questions I don't get to during the class, make sure you send those to Jerry at traderspro.com. All right, let's get started. We're setting up here to probably have a pretty big decline. At least that's what some of the price action is showing. We're going to talk about that today. And you know, again, it gets back to the rally. The rally we're in, it just didn't make a lot of sense. Now it's making a little more sense as it's rolling over, because I didn't expect it to come charging all the way back. There's some key things that are happening. So a key thing happened on Friday. That's something I talk about all the time. I'm gonna bring up today. We're gonna learn about it today and make sure we are aware of it and why we look at some of those things. But let's jump right into it. The direction alerts. Now these aren't really showing any sort of extreme. Momentum is in the buy area there. Breadth is moving from high into trending. So we're not really expecting to drop from an extreme condition, except for sentiment. Sentiment it's been that way for a while. There is buy-sell ratios are not too wide, so there's not a big extreme there. But the sentiment indicator had reached that overbought area. So in a near term, we were overbought a little bit as we started to roll over here. So a lot of the signals aren't real. I mean, we're not, like I said, we're not. This is not one of those where we get these extreme conditions and then we start to get the overbought or the bearish reversal price action. But that typically the major reversal signals usually happen when you're in this big upward trend like this. And that's where we were several months ago, where we kind of peaked out. We did get a lot of these signals back then that were signaling that we could decline a little bit. Now we've had a decline down over a few months and we've rallied up. And so what we're expecting here is that this is, and I'll show you when we look at the chart, but on this, when you roll over on this peak, usually you're not going to get, well, you can, but you don't have to have the extreme conditions in order to kind of roll over at that point. So usually you'll see those at the first decline. And remember, I often talk about this. Typically, declines don't happen in one move. You'll get the initial move. You'll get a sucker's rally. And that's what I'm wondering is, was this rally we had for the last few weeks, is it a sucker's rally? We still don't know yet for sure. It's only going to be obvious in hindsight if we're looking back. But again, there's some key things I'm going to talk about today that make me believe that it is rolling over and that it was a bear market rally. One thing that kind of maybe signaled the possibility of a little bit of a pullback. If we remember, under this index tab, we were looking at some of the indicators were getting close to the double-digit buy-sell ratios. Now they weren't all extreme, but they were right up there against the double digits there. We said we're going to keep an eye on that because that could be a signal that things are getting a little bit overbought in the near term or getting a little bit extreme in the near term. Obviously, in hindsight, we're seeing that they've dropped back down, and we'll see if that continues, if the market does roll over here. Let's get right to the charts, though. Well, before I start talking about the charts, there's a saying that you hear all the time. If you've been in trading for a while, and if not, you'll hear it at some point in time, especially when people are talking about the Federal Reserve. There's a phrase in trading that says, don't fight the Fed. Don't fight what the Fed is doing. Now, typically people start saying that when the Fed starts lowering interest rates, because whenever they lower interest rates, that usually means the market is going to take off. And you'll hear people come on TV and they'll say, Fed is lowering rates, or their policy is to lower rates. Their policy is to ease And you don't want to fight that. That means the market's going to go higher. It's almost always going to go higher, pretty much always going to go higher when the Fed is doing that, okay? And that's usually when you hear that phrase, don't fight the Fed. You never seem to hear it when the Fed is moving into a tightening phase. I have not heard it from anybody that's been talking about Fed policy. The Fed is now raising interest rates. One of the most dumbest Fed members today came out and said that the Fed is going to be rising rapidly to catch up. That is a tightening phase. So don't fight the Fed. If the Fed is going to be tightening now, and tightening measures often are geared towards slowing the economy, and obviously we need to slow the economy to bring inflation under control, but that can mean recession. And so we have, if we're going to be using that phrase on the way up, we've got to be able to use it on the way down, or at least be aware of it. And now I don't base my whole trading system off of something as general as that. You know, if the Fed is lowering interest rates, it doesn't mean you can't have 2 or 3 week declines in the market that can wipe out big moves. You're still going to be trending, and trending means up and down as it goes, stair stepping. But if the Fed is tightening, then we could expect to have more of a downtrending market. And remember, the market's always forward looking, so it should happen before. You know, people keep talking about, well, recessions don't show up until, you know, when we talked last week. We talked about the yield curve, the bond yield curve inverting, and typically you don't see a recession for several months after that happens. That's true, but remember, the market is always forward looking. So if the market believes that 6 months from now we could be in recession, it can start selling off now ahead of that. If you're going to wait until you get a recession, it's going to be too late, because at that point the market's going to be saying, okay, we're in this recession, we're going to likely be out of it by next year, or start moving out of it by next year, so I'm going to start buying right now ahead of that. You're going to be late. You're going to be selling, or you're going to be starting to short the market when the professionals or the smart money is going to start to buy it. So we always have to remember that the market is forward looking, and that's why we want to focus on what the trend is doing and what the price action is doing. And that brings me here to the SPY again. What we had happen here is we had this decline. When we had this big run up right here, then we had this decline right here last week. And it may not have seemed like that big of a deal, but a couple things I want to point out, because this is something we've been really focused on. I've been focused on this little area right here. That was the January 10th low, February 2nd test, February 9th test. We broke above it right here. And if you remember last week, I was saying, well, that was bullish that we did break above it. But we wanted to see, is it going to hold that? I was a little bit nervous about the gap up as it moved up above there. Sure enough, it reversed right away, and now we're back below it. And then look what happened today. Today we had an intraday high that came right up to that exact level, and then we've reversed it. So here's where we opened today. We tried to rally up, we reversed it, and that's not good. Not to mention the fact that typically when you have these declines, you have the initial sell-off, you have the bounce, and then this is either going to be wave C, and if it's wave C, maybe we come down into here and then we find some support, and maybe we do turn around and come back up. But if this is bigger, this could be, from an Elliott wave standpoint, this could be wave 1, wave 2, and this could be wave 3, wave 4, wave 5. We could end up retesting these lows down here, and that's kind of what I think is going to end up happening. But again, I can flip-flop on that if I see something different. I'll be more than happy to flip-flop that, and especially if it gets down into here and it looks like maybe more like wave C, and then you get a real strong move up, and then I'll look at that as maybe an ABC pattern right there. But this whole drop the reason why I'm a lot more bearish is, you might say, well, Jerry, these drops happen all the time. Why does this have to lead to something much bigger? Well, this is where I'm going to skip ahead, because something happened on Friday that was significant, something we look at all the time. And I'm going to skip down here on our list. We'll come back to some of these other ones, but I want to skip down here on this list. And I want to go right to the SMH, the chip stocks. Remember, the reason why we look at the chip stocks is they tend to be a leading indicator, and particularly of the NASDAQ 100. The NASDAQ 100 is mostly a tech index. Obviously, tech stocks need chips. So if the chip market, chip stocks are doing well, it usually means the other those tech stocks are doing well. What we saw was a very sharp decline, an unusual decline late last week. We dropped by a bigger percentage in the chip sector than we did in the S&P and in the other indexes. Okay, that was significant. Now, along with that, which is maybe even more significant, is another one that we look at. Is we look at the Dow Transportation Index. The IYT is what you can use to follow this, and this you want to compare to the Dow Industrials. It tends to be a leading indicator of the Dow Industrials. The transportation stocks, these are railroad stocks, airlines, shipping companies, trucking companies, any type of UPS, FedEx, companies that are moving products around the country. If they're doing well and they're making money, it usually means you got a nice, strong economy and things are going well. Now, again, you could argue, well, wait a second, things are, the economy is heating up, is heated up. That's why inflation is spiking, right? Remember, the market is forward looking. If you've got a Fed that's slamming on the brakes to the economy, what's going to be impacted by that? Or where would you expect to see the first impact? It's going to be on transportation stocks. And we saw on Friday that the Dow Transports got completely hammered. That was a very significant move. Now, remember, the chip stocks and the transports are leading indicators. So if they're dropping, and both those now are dropping. So you've got tech that's worried about the future. You've got industrials that are worried about the future. There's the warning sign right there. Friday was a warning sign. And again, let's compare the transports to the Dow. You see what I mean by leading indicator? That was a decent drop, but that's not a big, huge drop. It's trying to fight to hold on. The Dow stocks have not reflected that yet. Now, again, it's whether or not you believe that those indexes are leading indicators or not. You could say, well, I don't believe that. I think the transports are overreacting, and you can make up all these excuses for it. But there's a reason why a lot of traders look at those things. And I've heard nowadays that I've heard a lot of people say, because looking at the Dow Transportation Index versus the Dow Industrials, it's what's referred to as the Dow theory. It's been around over 100 years. Okay, the markets have looked at this for over 100 years, and within the last few years or so, the last decade or two, there's been a lot of people that said, you can't focus on that anymore. It's more complex than that. We're not in the 1800s anymore, where railroads are the number one. The railroads were the tech stocks back then, and things like that. You got to look at the chip stocks are more of a leading indicator. Well, I'll give some credence to that we're not as dependent on the transportation stocks for the whole economy as we used to be. But that's why I look at both. And right now we got both that are showing that leading indication that things are heading down. So that's why I look at those. They're not always going to be telling you something, and that's why I always say about the VIX too. We go through these, and sometimes I just kind of touch on them real quick. And the reason why I touch on them real quick is because they may not. All they might be doing is just confirming what we're already seeing. The chip stocks are up, the market is up. There's no, there's really, it's not telling us anything we don't already know. But when we start to see it diverge, or when we start to see it make these big moves, big proportional moves, we want to pay attention. And that's what's taking place right now. And again, I want to point out that warning came on Friday. So we have Friday's move. Let's go back to SPY. So we had Friday's move. Actually, wait, that was Thursday. Was that Thursday's move? Thursday? No, that was Friday on the. Let me go back there because I'm pretty sure that was Friday. Yeah, that was Friday's move on the. So it did decline on Thursday as well, but we had the big drop on Friday. So we had the big drop on Friday, and we actually had a little bit of a bullish revert. We rallied off the lows at the end of the day on the S&P 500, and then it looked like we had a strong rally yesterday. But now the transports did kind of pause yesterday, but they were flashing that warning sign early. Now, I don't, in hindsight, you can look at this and say, well, boy, Jerry, why didn't you just short the market heavily on Friday if you're getting that warning signal? Well, again, with warning signals can come a week before the move happens. So with some warning signals, it's not that we're going to trade them, but they're warning us. They're telling us to look out. And what I've been looking out for is a bearish reversal signal. Okay. Yesterday or Friday, we didn't get a bearish reversal signal. That was more of a bullish hammer right there. Yesterday, we didn't get a bearish reversal signal. We closed at the highs of the day. Today, though, we're getting the bearish reversal signal. We rallied up to this critical area here, and then we reversed it. We're now at the lows of the day, and I would assume that we're going to probably fade into the close and could get really fade into the close, which is one of the reasons why I'm going to try to wrap up class a little bit early today because I got some trades I want to get into at the end of the day here. But I think we're going to have a big move. Another reason why I think we're going to have a big move is related to the VIX. See, the VIX is very low. I talked about this as well. We'll look at the VIX here in just a second. But the VIX is showing no concern yet about this, and I think it's going to start showing it here pretty soon, probably as soon as tomorrow. Dow, the other indexes, I'm not going to spend a lot of time on, except for maybe the Russell. Let's go to the Russell 2000 because this is at key support resistance. We tried to break out above that. We're right back down below it. We rallied up to it again right here. We're rolling over. I mean, this thing just looks like it's heading down. This is a bearish head and shoulders pattern right here, if you want to look at that. Bonds are still heading lower. This, again, ended up being just that correction. Remember, we were looking for it to get above here to see if maybe it would be a trend reversal in bonds. Didn't get there. It's rolled over. It looks like it's heading to a lower low. Had a big spike today on yields. And again, you don't usually get big spikes in yields, but you got a big spike in yields there. It's caused a pretty big move in the bond market there. It's still trending down. Gold is it's just kind of caught in a area right here. I can't tell on this if this is maybe wave A, wave B, and we got to move down before going higher. This one's just, I would, usually in a situation like this, I'm going to take this high right here and this low and say if we break above here, that's bullish. If we break down below here, that's bearish. Right here, it's a coin flip. I don't know where gold is going to go, and it's not worth spending a lot of time, because the probability, even if you do guess right, you got a 50-50 chance to guess you're right? It's a coin flip. And I don't see anything that would give me a higher advantage to tell me it's more likely to go up or go down until it can break out above here or down below here. Oil is kind of the same way. You could probably draw, and I think I did this last Thursday, but you can draw a trend line through here. You're just waiting for it to either break out above there or down below here, but it's in the same kind of indecisive area there. The dollar, we talked about this being a corrective, more of a corrective pattern. It's close to breaking out. It should break out, but sometimes, again, it could come back down, and we could stay sideways here for a while. You'll break out at some point, but typically after it tests a couple times, it usually will break out. It's pretty rare to get, triple tops or quadruple tops, and so I would assume that the dollar's going to break out right here. We'll see. We should be able to see that by Thursday, see if it did. All right, let's get to the VIX. So the VIX is way down here, but we're getting a bullish reversal candle today. So we're down at these very low levels. What that means is that the market isn't reflecting any fear yet, but the charts are saying or suggesting that we're going to get a drop here, and those professional traders aren't running to buy the protected puts. I think they will. They might just be, well, I kind of think like those big money professional traders a lot of times, and if you remember, you can't get in and out of these positions very quickly, and so you might be looking at that big run up we had. You're still not sure, you're still not sure if this is going to be. Let me go back to the SPY right here. You're not sure if this is just wave A, wave B, wave C, and then you're going to take off again. So you don't want to be panicking and spending all that money on protected puts if this is just going to be a 2 or 3 day decline, and then we're right back again. But I think if we start to drop down further below these levels, you're going to start to see that fear pick up, and you'll start to see that VIX spike. So that's something we'll keep an eye on. Because, like I said, this is showing. All it's showing right now is there's a high probability we're going to drop in the next few days. The next question is just, is it going to be wave C? Now, the reason why I keep pointing this area right here is that typically ABC patterns, if this is a wave C will tend to be about the same length as wave A. So if that's wave A, wave C would be about this length. You could look at, there's resistance there that could come into play. A little bit of resistance right in here. That could help you with maybe targeting a spot. But that's why I kind of keep looking at that area. If that's just a wave C. So, we may see the VIX spike a little bit, but it may not get them into that panic level unless it drops below that. If it's no longer looking like a wave C, it's looking like a bigger decline. I think you'll start to see that spike up a little bit. So again, if I go back to the VIX, it bounced a little bit right here when we declined last week, but then it had that big move lower yesterday, and then now it looks like it's having a little bit of a bullish reversal. And then Bitcoin, well, Bitcoin actually already broke above here, but again, it had this little drop. It doesn't look like it's going to collapse necessarily, but I have if the whole market starts selling off, I think just about everything starts selling off. Usually that's what happens is people start selling everything, and I could see Bitcoin dropping a little bit if that happens. All right, so what does that mean? Well, first of all, it means we don't want to be getting anything new right now. Why get aggressive here if we could have, especially if we come down and retest these lows? That could be a big decline if we get all the way down to there. And I want to have capital if we get down to there to jump back in again. I mean, we were able to take advantage of this move, get the portfolio back above 100,000. And I want to be able to have the majority of that capital available. So let's go to the portfolio here. Now, I'm not just going to jump out of everything, but I am going to tighten up some stops. Now, let me pull up. So I think on OAS, I have my stop right below here. I think I'm just going to keep that. I don't think I'm going to do anything until it drops below there. It's hard because, I go back to net here. I mean, this looks just like what we're talking about. This looks like wave A, wave B, and this is either wave C or we're heading down in a bigger move. My stop's all the way down here. I think what I was going to do is put it right below here, but we're almost there already. So I may stop out of this at the end of the day here today. I'll have to see, because it got down that line. It's come up a little bit there. It was up a little bit further, so I thought, well, I'll put a tight stop down below here. NOC, I believe I have my stop below here, and it's trying to hold up here, so I might go ahead and just keep that stop at that area there. Same with the LMT. The LHX, I think it's down below there, and actually LHX is up today. So I don't think I'm going to panic on some of those. But what I do want to add today, because the question could be, okay, well, what do we do? Do we just stay out and not do anything? See if the market drops and then come back in? Yeah, you can do that. Now, if you believe that the market could drop and you want to try to take advantage of that, I don't like shorting stocks. In fact, I never short stocks anymore. It's just too much of a risk. I buy put options if I want to profit from something dropping. But if you don't know how to trade options, there are other ways that you have these inverse ETFs that actually go up when the market goes down. I have a watch list of them here that I keep on. These are the inverse ETFs for the indexes. So the SH right here is short the S&P 500. So this is going to go up if the market goes down. And you can buy these like a stock. It's currently trading at $14.05, and it should go up if the market goes down. Now these don't make big moves. I mean, you look at it here, and you could get a big drop in the market and only get $1. That would be about $1 move in the SH. So you don't get big moves on this one. That's why I bring it up as an alternative. I mean, if you think you're going to be trending down in the market for a little while and you want to make some money on it, you can do that. Now there's other ones out there. One that I want to get into on the portfolio, that there's a fund out there which is it's called the ARK Innovation Fund. It's kind of a higher risk, kind of a tech heavy index. It did really well during the rally off of the lows after the pandemic. So you had this big run up right through here. Kathy Wood is the one that runs it. Some of you maybe heard of her. Well, it's had this big decline, and from a chart standpoint, that's a huge decline. Yes, at some point you would expect that it should start to trend up. However, again, these tend to be riskier stocks. She owns a lot of Tesla, for instance, and I'm trying to think of some of the ones that are in the fund, but she owns a lot of these stocks that were part of that stay-at-home type trade. Well, again, if you think the market is going to drop, a lot of these stocks are probably you're probably going to see this come down and retest these lows again. It's kind of following the same thing. It had an initial drop last week, tried to rally, and it looks like it could start to work its way back down, maybe retest these lows or go lower. Well, there's an ETF that somebody set up because this had started to have such a big decline. There was a big fund managing group that decided to bet against Cathie Wood, bet against her ARK Innovation Fund, and so they set up an ETF that does the opposite of it, and it's called SARK, SARK. You can see it hasn't been trading very long, but it'll do the opposite of what that fund will do. But you can see here that what might make, now this had this decline right here, but had an initial move up, can pull back. Looks like this is getting ready to go higher. So what we could do with this is we could, a lot of support right here. I don't think that ARK fund's going to reach new highs anytime soon. So I could put a tight stop below here. And this one moves a little bit better. I could get a $2 move here, a $4 move here. I could really make some money on this thing if the market does roll over and drop and those stocks go down. This could go up. Now, if I'm doing this type of trading, I'm not going to be worried about, and especially an ETF, I'm not going to be worrying about strength rank or anything else. I'm just trying to take advantage of a market move here, and so I'm going to get in. Let's see. I'm going to put my stop below these lows right here, so it's going to be 42.65. We'll say 42.60 is our stop. And so let's add this to the portfolio. $42.60 is the stop. 100 shares. I could go higher than that. So let's do 200 shares. All right, 200 shares. I've got about 9,000 would be in there, and the portfolio at risk, I'm well below 1, so I have very little risk. I'd only lose about $620 if I'm wrong. So we'll just keep that tighter stop on there. And let's go ahead and place this. So I think that combined with, keeping the tighter stops on these other positions. So if we do decline, we're not just what I want to make sure I don't do is just if the market starts declining, be making money here, but we're losing it on all these dropping. So we got pretty tight stops on the defensive stocks. This is an oil stock. Had a tight stop on that one. Net is the one that I might end up stopping out of today. That was a tech stock. But the idea is that, maybe all this does is offset some of the losses if we get stopped out of these. Maybe, who knows, maybe these all hold up and they go up, or they don't get stopped out. We make good money on this, and the market is just in a wave C, and then it starts to go up, and then these stocks start taking off again or something like that. But it gives us a little bit of a defensive element in the portfolio there. Question, do I trade options? I'm actually mostly an options trader. like I said, I don't day trade just because I don't like to watch. I don't like to watch my computer screen all day long, which you pretty much have to do if you're going to day trade. I swing trade options where I'm in them for a day or two, which is why I recognize a lot of these short-term reversals that you see. The reason probably why it has zero. I think you're asking about strength rank. Is that right? Some of these, like SARC, hasn't been around very long, so it probably hasn't traded long enough. I don't know. You might want to email me that question because I'd have to probably take some time and look at some of those what you're asking there, and I just don't have time in class to do that. Sometimes it could just be just a short-term glitch. You got anytime you have these software programs and with market data, they can be glitchy sometimes where you've heard me talk about it before where on our we've been looking our direction alerts, suddenly this little bar will disappear or something like that, and it can just be a little bit of a computer glitch. And if you see something that doesn't make any sense like that, let me know, because then I can pass it on to the programmers. Sometimes they don't know when there's a problem until somebody sees it and tells them, and they can usually fix it pretty quick. But that would probably be what an answer to your question there, is that some of these things haven't been trading long enough maybe to have a strength rank, or there just could be a glitch in the calculation there. All right, so I added that. Again, I might be stopping out of, let me see how net looks here. Yeah, it's kind of holding up. We'll see how that looks at the end of the day. See how the indexes are looking here. And it is possible, again, if let's say we rally into the close, it is possible that it tries to move up a little bit higher. You try to predict exact moves. You can't do it, for one, but and usually even with these candles, they're based off of the close. I'm assuming this is the way it would look at the close. If that's the case, that's still a very bearish reversal day today, in context with everything that's happened. But what if in the next hour we rally all the way back up to the highs of the day? Well, that candle will look different, and it could mean that that you get a bearish reversal tomorrow, or that the market tries to rally tomorrow again. But it still would be a warning sign that we're probably going to get this drop. And like I said, it still wouldn't erase what the Dow transports and the chip stocks did on Friday. That was screaming a bearish signal, a warning signal then. And so I'd still probably be expecting the market to drop at some point. I'd love to get a call right perfect every time. I still think this is pretty good, that we should probably drop tomorrow and keep dropping for a few days. But even with some of my and I consider myself a pretty good expert for recognizing bearish reversals, particularly. One of my better calls was just recently was the pandemic collapse. We started to get bearish signals, warning signals that something big was about to happen. We started flashing them, and I said, we're going to get a drop, and it's imminent. It's going to happen real soon. And it took another week, and then it dropped, and it dropped. You remember that. It dropped big. It was the biggest drop speed-wise that we've ever seen in the market. It dropped faster than the market's ever dropped in its history. But even then, I didn't perfectly time it. It was a few days. It was almost a week. It was about about 4 or 5 days later. And that's why I'm saying the same thing could happen here. Could it bounce around here a little bit before then dropping? Yeah, and that's an important point too, because if you do know how to trade options and you're looking to buy options, remember options have an expiration date. It's going to be real tempting if Jerry's saying that we're going to drop here any day now, or maybe even tomorrow. Boy, those options that expire this Friday are really cheap. I'm going to go buy those. Well, if you bounce around the rest of the week and then you drop next Monday, you might be right that we get a big drop, but you're wrong on your option trade because your options expired and they probably expired worthless. So, you always want to give yourself a little bit of time if you're option trading. I would go out to at least next week in case it does bounce around a little bit right into here. But all right, I'm going to wrap things up. And especially since there's really not anything else I want to do here. So I didn't, I'm not looking to go into the sectors right now. And especially too, you look at the sectors, oil, we decided that oil was kind of, the oil chart was kind of in that indecisive area. It could go either way. And then you look at the rest of these, if the market's dropping, you're going to see bank stocks drop. You're going to see, by the way, the big component of the Russell 2000, the two sectors that make up most of the stocks in the Russell 2000 are oil and energy stocks and bank stocks. And so if the Russell 2000 looks like it's about to drop, I don't want to be jumping into these sectors. I definitely don't want to be getting computer technology if the chip stocks are looking like they're dropping. Business services, same thing. So this is one of those where and a lot of times if I see a really strong bearish chart on the indexes, I don't want to look into here because I could find a stock, okay, out of that group. But if the market is screaming that it could be dropping and maybe even dropping pretty big, I don't care how bullish that stock is looking. I don't know if I want to take that chance because when the market sells off in a big way, it doesn't matter how strong the stock is, it's going to go down with it. In fact, you look at Apple. Apple is outperformed. It shook off. It didn't even drop that much on the drop. But guess what's going to go down if the market starts selling off? And it has a bearish inside day today. Apple's looking like it should drop as well. So, Apple's showing weakness. If Apple's showing weakness, then in fact, I often joke that I ought to add Apple into the market update as being the fifth index that we look at. Because it's so big, and a lot of times the market will tend to move. If Apple looks good, it'll tend to be good for a lot of, particularly the tech stocks. We don't though, because the Nasdaq 100 is good enough that it reflects Apple's movement in the Nasdaq 100, and it's a little bit more broad, so we're not just focused on one stock. But I do look at Apple a lot of times. If I think the market could drop, and I see weakness. Last week I saw weakness in Apple right here. An bearish inside day right there. That was saying that there's a good chance the market could pull back a little bit right there, and it did. So, I'm not against keeping an eye on it and looking to see how it, if it really starts breaking down and having a big sell-off, look out. That means that the market's probably having a really bad day as well. All right, let's get out of here so we can. If we have to make adjustments to our portfolio going in the end of the day here, if we can, or get in some trades at the end of the day. If so, I have to get into trades. They better be bearish type trades. I would, or these inverse ETFs or something like that. All right, thanks everyone. Have a great week. We'll see you on Thursday, and again, we'll probably have a better idea what's going on Thursday, and and a lot more to talk about on Thursday. Hopefully, a lot more to talk about, and we'll see if this plays out the way it's looking like it could play out. Maybe it doesn't, and if it doesn't, we'll hopefully be able to see some reasons why, or maybe, like I said, maybe it's trying to just hold on, and but it's still looking bearish. We'll see. We'll see how things look on Thursday. All right. Thanks, everyone. Have a great week. Bye now.